Well, thanks very much, Peter, for the opportunity to talk here today. As you mentioned, I'm going to talk about sustainability reporting and particularly the role of materiality in sustainability reporting. So let me just start by talking a little bit about what we mean by materiality. Materiality is basically the filter which determines which information gets included in a sustainability report. And I've listed a definition here. It's aligned with the US Supreme Court definition. It's my own version of it, but it's a good representative definition. Information is material if there is a substantial likelihood that its omission would influence the decisions that reasonable users of the report make based on such reports. And I've emphasized that the focus here is on the users of the reports and the decisions that they're making. And this is where things start to get complicated. I've got a matrix here which shows at the top the two popular type sets of reporting standards that are in use today. One is put out by a body called the GRI, the Global Reporting Initiative, and the other are put out by a body called the SASB, which was recently consolidated into the ISSB, the International Sustainability Standards Board. And I'm going to be talking about the ISSB's definition of materiality here. So who are the intended users? Let's start with GRI. The intended users here is defined as stakeholders, groups that could be affected by the organization. This is a very broad definition. It includes, for example, trade unions, civil society, vulnerable groups, as well as the common stakeholders like investors, employees, and customers. And the decision-making context here is assessing how they're affected and making informed decisions about the organization's impacts and contribution to sustainable development. And this is sometimes called impact materiality. Now, if we turn to the ISSB, their intended users are much narrower here. It's existing and potential investors, lenders, and other creditors. And the decision-making context is making financial decisions relating to providing resources to the entity. It's basically investors making investment decisions. And this is typically called financial materiality. It might sound familiar because it's exactly the same definition of materiality that's used in traditional accounting standards and financial reporting. Now, before I move, I want to mention one more set of standards that's just coming into play here from the European Commission, the European Sustainability Reporting Standards. What they do is adopt a double materiality perspective. They claim to satisfy both sets of users for both decision-making contexts. And in theory, that sounds good. In practice, it means that it's hard to focus on just one set of users and one decision-making context. There's a lot of different information there. Okay, so I use a schematic here to illustrate this concept of double materiality. And down at the bottom, we have the environment and society having financial impacts on the firm. This is the financial materiality. And I sometimes call that protecting investors. We can think of this as providing information to protect investors from making bad financial decisions. And up at the top here, we have impact materiality. The business is having impact on the environment and society. And I often call this protecting humanity. The goal here is to report out to stakeholders to help them protect the environment and society. And I get three common questions here that I want to quickly go through with respect to this concept of double materiality. The first one relates to financial materiality. Isn't financial materiality already reflected in the financial reports? And that's certainly the case. If a company has to pay an environmental fine or it suffers a weather-related event, for example, it'll incur those costs in its financial reports. They'll report on those costs. And under current financial reporting, companies also have to estimate some future costs like asset retirement obligations, environmental obligations, and loss contingencies so long as they're probable and reasonably estimable. So what's really left for the sustainability reports in the financial materiality angle? Well, what the standards tend to focus on are what they call risks and opportunities. And these risks can be divided into transition risks, which are costs that will be imposed as we try and move to a more sustainable society, for example, carbon taxes or carbon capture technology, or physical risks, which are risks that might occur as we struggle to get to a more sustainable society, for example, weather-related events associated with climate change. And then there's also the opportunities. If you're a company that can help companies, other companies and businesses deal with their transition risks and physical risks, that could be an opportunity. But what I want to emphasize here, these are more forward-looking, qualitative type disclosures. And for example, a company at this point in time might not have a good idea to what extent it will face transition risks versus physical risks, because the type of action society is going to take are really not clear at this point. The second question that comes up is there considerable overlap in information across the two groups? Sometimes it's referred to that there is. That's far from clear to me. Now, don't forget here that the reason we have a lot of these issues of sustainable development is because many of these consequences that businesses have on society are externalities. Take, for example, greenhouse gas emissions. Companies bear little of the cost of their own greenhouse gas emissions. They're spread broadly over society and the global economy at large. And so traditionally, these problems have arisen simply because they're not financially material to the companies. And the challenge here is to make them financially material. So there's not a natural overlap, I don't think, in the information, or that's dangerous to assume that financial materiality will take care of impact materiality. And the last question that comes up here is, okay, there's a lot of focus on protecting investors. Why not prioritize humanity and protecting humanity over protecting investors? And here it's important to realize we have a long tradition of regulation aimed at protecting investors. Over 100 or almost 100 years ago now, the SEC was formed in response to the great stock price crash and charged with protecting investors. So we have an existing financial reporting framework here, and to the extent we can slot sustainability reporting into that framework, we can be up and running pretty quickly. On the other hand, protecting humanity with respect to sustainability reporting, we don't have a framework. And the European Sustainability Reporting Standards are an effort to create such a framework, and hopefully something that will be rolled out globally. But we're still struggling to come up with a regulatory framework to require these types of disclosures. This brings me to my last point here, and it relates to the concept of dynamic materiality. And what I want to emphasize here is that the way we ultimately promote sustainable development and get businesses on board is by making actions that promote sustainability and sustainable development financially material. And what we really need to do in order to get there is to understand those issues and to report out on them to stakeholders so that society can figure out how to make them financially material. So there's a bit of a chicken and egg problem here, but what I want to emphasize is that sustainability reporting that focuses on impact materiality really is critical to this concept of dynamic materiality and having society figure out ways to make these issues financially material to businesses so that they can internalize those externalities and we can move forward in a world with sustainable development. So thanks very much again for the opportunity to talk, and I'll hand things back over again to Peter now.